Structure your money, stabilize your life. Welcome to Kelly Sharing. I'm Kelly, sharing practical and thoughtful insights on money. A few years ago, I had a friend. Let's call him David. At 30, he had a good salary, a car, a house, and even invested in funds. Everything looked solid and confident. Then one day, he got laid off suddenly with no income for 3 months. Credit card bills, mortgage, and medical expenses, all that financial security disappeared fast. What did he do? Sold investment at a loss? Tap retirement accounts and pay huge taxes? Even took high-interest loans? That stable life collapsed in an instant. And this isn't unique. It's a shared financial blind spot for many. Most people hear this story and say, he just didn't save enough money. But look closer, the real issue wasn't just low saving. He didn't have financial structures. A properly structured financial system doesn't collapse from a single event. A complete financial structure must cover 4 layers. Cash flow buffer, risk protections, growth engines, tax and account structures. Think of them like 4 load-bearing pillars. Remove one, maybe nothing happens today. Add pressures, things crash fast. And this isn't rare. According to the FINRA Investor Education Foundation, more than half of U.S. households would struggle to cover a $2,000 emergency expense without borrowing and selling assets. This tells us something important. The issue isn't income level, it's structural readiness. So in this video, I'm going to give you a framework, the 4 core layers of financial structures. You can use it to audit yourself, score your setup, and find your weak spots. Let's start with the most ignored but most critical layer, cash flow stability. Let's go back to my friends who got laid off. Most people ask, did he invest long? Was he underinsured? But his biggest problem was actually simple. He didn't have enough usable cash. Not that he had no assets, but he had no immediately available money. He had funds, retirement accounts, even home equity. But none of that could pay next month's bills. This isn't rare. According to the Bankrate Emergency Savings Survey, more than half of U.S. adults cannot cover a $1,000 emergency expense using saving alone. They would need to borrow, use credit, or sell assets. The U.S. Federal Reserve Household Financial Wellbeing Report tracks something called Emergency Expense Readiness. It constantly shows that many households still rely on debt for unexpected costs. Here's the counterintuitive truth. Financial collapse rarely starts with investment loss. It starts with cash flow breakage. The market doesn't knock you down first, your bills do. So in the financial structures, the first layer is never investing. It is cash flow stability. The real question isn't, how much do I make? It's how long can I survive if income stops? How long without selling assets? How long without new debt? Your cash buffer is like an oxygen tank for diving. You barely think about it until something goes wrong. Then it determines whether you come back up safely. So, step 1 in financial structures is to build a cash buffer layer. Cash buffer gives you time, but it doesn't absorb big shocks. That's why the second layer exists, risk protections. I once worked with a dual income couple. Good salary, clear plan, save, invest, upgrade home, fund education. Everything was on track. Then one year, the husband was hospitalized for 3 months. Not a critical illness, but long enough to stop working. 3 things happened. Income dropped by half. Medical bills piled up. They started liquidating investments. Money meant for growth became money for survival. It wasn't investment failures. It was unprotected risk. Many people underestimated the financial shocks of medical events. According to the Kaiser Family Foundation's KFF, medical debt remains one of the leading contributors to personal bankruptcies and financial distress in the U.S. Even with insurance, out-of-pocket costs plus lost income can create major financial strain. Now here's the risk many ignore. Income interruptions risk. According to the U.S. Social Security Administration, roughly 1 in 4 workers aged 20 will experience a disabling conditions before retirement that prevents them from working for a period of time. This is why risk protection is not optional in financial structures. It's a risk isolation layer. Its job is not to make money, but to prevent false damage, prevent false asset sales, protect long-term investment plans, stop one event from collapsing everything. If your cash buffer is the oxygen tank, insurance is the firewall. Fire may never come, but if it does, without a firewall, it doesn't burn one loan, it burns the whole building. So risk protection isn't about, do you have insurance? It's about, is income risk covered? Is major medical risk covered? Is family responsibility covered? That's what structural protections mean. Once risk is properly isolated, your financial structures finally has the conditions for sustainable growth. Otherwise, every unexpected event resets your long-term progress. Now we can move to the third layer, the growth engines. I have seen two types of investors. Type 1, excited in bull markets, act small when it rises, panics but holds when it drops. Type 2, also invest, but never gets forced to sell during downturns. The difference isn't fund selections, it's structural strength. Type 1 use investments as an emergency ATM. Type 2 use investments only for long-term growth. According to the Delbar Quantitative Analysis of Investors' Behavior Report, the average investors constantly underperforms markets index over the long term. Not because investments are bad, but because of behavior. Buying high, selling in panic, exiting at the long time. Why do people sell at the long time? Often not because of emotions, but because of necessity. They need cash, income interruptions, medical costs, unexpected expense. Long-term assets get forced into short-term use. That's not an investment mistake. That's a structure mistake. On the other hand, long-term market growth is powerful. According to S&P 500 long-term historical data, over multi-decade periods, equity markets saw sustained upward trends. Long holding period dramatically increased probability of positive returns. The real question isn't, should you invest? Does your structures allow you to stay invested long-term? The growth engines layer is not about quick wins, chasing trends, timing bets. It's about compounding, sustainable growth, uninterrupted investment cycles. If the first two layers are cash buffer equal oxygen tank, insurance equal firewall, then growth engine is the engine. But even the powerful engines can go far without a stable frames and protection. Growth is the process, but what you keep is the result. That brings us to the fourth layer, tax and account structures. I once reviewed the finance of two people with very similar incomes, around $200,000, similar investing habits, similar risk tolerance. Years later, the outcome looked very different. One has strong accounts growth, but pay heavy taxes on withdrawals. The others have slightly lower growth, but much higher after-tax usable money. Because of better account structures, the difference wasn't stock picking. It was account and tax structure. Many people underestimated the long-term impact of taxes on wealth. According to Vanguard's research, tax-efficient account and asset location strategies can materially improve long-term net returns. Tax efficiency is the major component of total investment outcome. Morningstar research also shows investments held in tax-deferred structures often compound more efficiently because taxes don't drive returns each year. According to the IRS, the U.S. tax system is progressive. Marginal tax rate varies significantly by income level. The same dollar withdrawals from different account types can reduce very different after-tax outcomes. Most people look at investment return, professionals look at after-tax return, timing of withdrawals, income stacking effect, benefit eligibility impact. It's not what you earn, it's what you keep. So the fourth layer, tax and account structures answer this. When you have cash stability, risk protection, growth assets, How do you keep the maximum result? A full financial structure is like a building. Cash flow equal foundation. Risk protections equal firewall. Growth engines equal power system. Tax structures equal plumbing system. You don't see it, but without it, the building runs poorly. Now you have seen the full structures. Let's compare it with how most people actually operate. Most people are not doing nothing. They are just using random checklists instead of the real structures. Having investment accounts does not mean that you have financial structures. Having insurance does not mean your risks are properly isolated. High income does not equal high resilience. Many product does not equal to a complete system. High returns do not guarantee good outcomes. Focusing only on earning power and ignoring short resistance is a structural mistake. A real financial structure always includes cash stability, risk protections, growth engines, tax structures. Remove one layer, you create a vulnerability. Financial success is not about placing money. It's about building structures. Understand the structures matters, but seeing your own structure matters more. Many people know the 4 layers, but misjudge their structures when evaluating it alone. Because structural issues are very single point, they are intersections problems. If you have watched this so far, you're already starting to look at your own finance through a structural lens. The next step is to review your own structure clearly. If you're not sure whether your financial structure is solid or fragile, don't guess. Use the booking link below, schedule a one-on-one conversations, and we will walk through it properly. Clarity once can save years of detours. If you value this kind of structured financial clarity, like and subscribe. You can also share this with someone who would benefit from this framework. Thanks for watching and see you next time.